Hello, my name is Michael Reese. Today I'll be presenting on fraud audits in the Sarbanes-Oxley Act. We'll jump right into the fraud. More specifically, I'm looking at nonprofit fraud. Um, they did a survey of 1,396 companies, and 81% of those reported they had found fraud. In 2014, there was losses of fraud of $108,000. There are some guidelines to help reduce fraud, which include paying attention. Don't assume you won't be a victim. Have transparency, involvement. Inform those supplying you the money, such as lenders and donors, where that money's going. Share the workload, making sure that people aren't just doing one responsibility, which could maybe mean they're trying to cover something up. So share the workload. Next, we'll touch base on, is it bad audits or corruption? So there is a self-serving bias, which basically means if we're motivated to reach a particular conclusion, we usually do so. And another reason that audits can be bad, how do we recognize the information? When is it going to be an investment? When is it going to be a revenue? They suggested in the article that there ought to be a 5-year rule. So, say somebody was working for Enron, then they couldn't go work for the auditing firm, or if they had been at the auditing firm doing the audits for Enron, they couldn't go and work for Enron. So they should have be barred from working for the other organization they were dealing with for at least 5 years. Next, we'll talk about some of the pitfalls in financial reporting. So, for example, U.S. we use generally accepted accounting principles, also known as GAAP, and then there are some international standards. IFRS stands for International Financial Reporting Standards. So the example here is the Kraft acquisition of the Cadbury Corporation. And just to give you an example, when Kraft acquired Cadbury in 2009, using the IFRS, profits were recorded at $690 million, and using GAAP, that resulted in profits of $594 million. So there's clearly a difference there, and that may make any potential acquisition decisions a yay or a nay. Another example, Twitter, using GAAP, reported a net loss of $521 million, whereas when they were using other methods other than GAAP, they reported positive incomes twice, one of $557 million and the other of $276 million. We'll move on to the next subject here, Sarbanes-Oxley. This was passed in 2002. Section 4 seems to be the biggest headache for people. Basically, Section 4 states that management is to maintain sound internal control, and auditors are to maintain that soundness. Another big part for Sarbanes-Oxley Acts, try to control human error, which is still inevitable, which is just people can be fatigued, can be stressful, and there can be distractions going on around them. However, there have been some benefits to having Sarbanes-Oxley Act. For example, BlackRock investing, because they had a revised documentation when Sarbanes-Oxley Act took place. So BlackRock, they looked at their job descriptions and they had to revise those. And so once they revised those, they found that, oh, our new hires are catching on to the job quicker and not taking as long to be up to speed with the rest of the employees. And lastly, the conclusion here. So we can certainly see that fraud is still prevalent, more specifically in some other areas more than others, such as nonprofits. Humans act in their own best interest at times, but that may not be the company's best interest. Sometimes it's unintentional. Like I say, we are humans and we do make mistakes. Financial reporting, obviously, it's still a good measure. However, when you start mixing that with international accounting and reporting, it can get a little hectic and confusing there. What's really the accurate figure that we need to look at? And while the Sarbanes-Oxley Act may be burdensome, we can see it does have its benefits.